Welcome to the Finance Scope. Great to have you with us for our very first deep dive.
Hello. Looking forward to jumping in.
So today we're digging into the financial landscape for, well, the second half of 2025. We're working from some fascinating analysis that tracks a few really key questions.
Yeah, it's not just about the weekly noise, is it? It looks at how the narratives are shifting.
Exactly. And crucially, what that actually means for, jobs, getting a loan, your investments, the real world stuff.
And I think that approach it's really valuable. It helps you see the connections, right? How one piece of data influences another instead of just isolated headlines. Gives you a sense of where things might be heading.
Right. So our mission today, let's unpack the core questions raised in these sources, look at the data points they're using, understand the outlooks they're presenting.
And figure out why it all matters to you.
Precisely. Okay, let's dive in. First up, the big one everyone's asking. Will the U.S. economy actually tip into a recession in the second half of 2025?
It's definitely a top of mind. And the analysis, it tackles this head on.
Yeah, and they start with a number that, looks pretty decent at first glance. U.S. payrolls up 139,000 in May. Unemployment steady at 4.2%. Sounds okay, right?
It does, yeah, on the surface, continued job growth. But the sources really urge us to look a bit deeper. There's some nuance in the labor data.
Okay, like what?
Well, they specifically flag a decline in the labor force participation rate.
Okay. So fewer people are actually working or looking for work, even if the unemployment rate for those in the workforce is stable.
That's it, exactly. It can suggest some people are maybe getting discouraged and dropping out. And the sources also point to downward revisions for the March and April job numbers.
Meaning the job growth in those months wasn't quite as strong as we first thought.
Correct. Once they got more complete data, the picture wasn't quite as rosy. So you've got that positive May headline.
But these other points suggest a bit of softening underneath. It's not all pointing the same direction.
Right, it adds complexity.
The sources also bring up something else significant. Business caution. They're seeing companies hesitate a bit, slowing down hiring, delaying investments.
Yes, and they link that caution pretty directly to trade uncertainty, tariffs and the like. It seems to be hitting sectors like housing and manufacturing particularly hard, according to the analysis.
And that connection matters because...
Well, when businesses get cautious and pull back, it acts like a brake on the whole economy, doesn't it? It slows growth right down. And the trade issues, as the sources highlight, just add another layer of risk and uncertainty. It's not abstract for those sectors.
Okay, so with businesses being cautious and some softness in labor, what about the Fed? What's the analysis say about their stance?
So the sources are clear here. The Fed held rates steady in May at that 4.25 to 4.50% range. And importantly, the Fed chair really emphasized that decisions are, quote, data dependent.
Meaning they're watching the incoming numbers, not politics.
Exactly. They're signaling a very cautious wait-and-see approach. No sudden moves based on this data alone.
A careful balancing act, then. And the market. How are investors taking all this, according to the sources?
Well, the analysis suggests investors are still pretty concerned, especially about tariffs, and also about inflation sticking around. Sentiments apparently flagged a bit.
So, less optimistic than maybe earlier in the year.
Seems like it. And bond yields have been volatile, so there's definitely still some unease, some uncertainty priced in.
Okay, so let's try and bring all these pieces together from the sources. We've got the okay-ish jobs headline, but the underlying softness. Business caution linked to trade, a watchful Fed, and nervous investors. What's the bottom line on recession risk?
The sources kind of synthesize it like this. That strength in employment we saw, that provides a cushion, some resilience for the economy right now. But you combine that with the business caution, the worries about sticky inflation, the market volatility. It creates a really complex, kind of conflicting picture.
So not a clear signal either way.
Not really. Based on all that, they assign about a 30% chance of a recession actually happening in the second half of 2025.
30%. Okay, so possible, definitely on the radar, but not like the base case scenario based on their analysis right now.
Right. But, and this is a key but, they add that the risk increases if those trade issues get worse. It really highlights how tied together things like tariffs, business confidence, and the overall economy are.
And for you listening, seeing this 30% probability and the reasons behind it, it's useful, isn't it? It tells you the path ahead isn't simple. If you're thinking about your job or maybe a career move, knowing there's this underlying caution, even with decent job numbers, it helps you plan Maybe think about navigating potential bumps in the road.
It's about understanding the tensions in the data.
Okay, let's switch gears now. Still thinking about global factors, but moving to a specific stock everyone watches. Nvidia. Second big question from the sources. Will Nvidia's stock climb another 20% this year?
Yes, the AI story. It's been phenomenal. And the sources definitely acknowledge that. They point to Nvidia's record Q1 earnings for their fiscal 2026, revenue up something like 69% year over year.
Wow, 69%. That just shows the sheer scale of that AI demand, doesn't it?
Absolutely massive momentum. But then the sources introduce a pretty significant challenge, something directly tied to those global trade dynamics we just talked about.
What happened there?
Well, the analysis highlights a new $4.5 billion charge Nvidia had to take. It was related to halted exports of their H20 chips, specifically to China.
4.5 billion. Ouch.
Yeah, and as a direct result, their forecast for Q2 got trimmed by about $8 billion below what Wall Street was expecting. That's a really concrete impact of those export controls.
It really drives home how these geopolitical tensions aren't just background noise. They hit company bottom lines, even in cutting-edge tech.
Absolutely. Direct, measurable financial consequences.
And this is the fascinating part that sources picked up on. Despite that big hit, Nvidia's stock actually went up, about 5% after the news.
Yeah, that's the resiliency analysis flags. The explanation given is that demand for Nvidia's chips from other parts of the world stayed incredibly strong.
Ah, okay. So the rest of world demand kind of cushioned the blow from the China restrictions.
Exactly. While that China situation is definitely a headwind, the underlying global appetite for AI chips is just still enormous. It's helping offset that specific challenge.
Interesting. The sources also put this in a bigger context, right? Talking about a global AI arms race.
They do. They mention things like China's Made in China 2025 initiative and the ongoing export controls as factors really heating up the global competition in AI hardware. But the point is, even with that competition and restrictions in some places, Nvidia is still benefiting massively from AI adoption outside those restricted markets. The core growth story is still global.
So you weigh the incredible growth against these very real export hits and competition. What's the final probability that the sources give for Nvidia gaining another 20% this year?
Okay, so balancing those factors, the analysis lands on a roughly 55% probability of a 20% plus gain this year.
55%. So slightly better than a coin toss, but definitely not a slam dunk.
Pretty much. They say the AI story is still compelling, making more gains likely, but they explicitly call out the geopolitical risks, like those export issues, and also potential valuation risks. Is the stock already expensive as factors that could cap the upside?
Right. So for you, if you're an investor, this analysis really shows the complexity, doesn't it? Even a company riding a massive wave like AI isn't immune to global politics or just plain old valuation questions. It's a reminder to consider those broader dynamics.
I definitely need that wider lens.
All right, let's move to our third key question from the sources. This one hits close to home for a lot of people. Will mortgage rates drop below 6% by the end of the year?
Yeah, huge for affordability. The sources start with where we are now, 30-year fixed rates, hovering between about 6.75% and 6.90%.
Oof, still pretty high then.
Yeah. And they note other rates, like for jumbo loans or FHA loans, are also up there, way above that 6% mark we're asking about.
So what's keeping them elevated, according to this analysis? What's the main driver?
It really boils down to inflation, according to the sources. Even though inflation is slowing down, they describe it as sticky.
Sticky meaning it's just proving harder to get all the way back down, more persistent.
Exactly. Maybe embedded more in services or wages now. And crucially, the sources connect this to things like tariff-driven price pressures helping keep bond yields high.
Ah, okay.
Yeah.
So tariffs push up some prices, adds to the sticky inflation vibe.
Which makes the bond market nervous, keeping yields on things like the 10-year Treasury up.
And mortgage rates tend to follow those treasury yields. Got it. That ripple effect again.
It really is all connected. It shows how those big macro things translate directly into your borrowing costs.
Does the analysis mention any forecasts for where rates might go?
Yeah, they cite some projections from places like Fannie Mae and Goldman Sachs. These suggest rates might ease a bit by late 2025, maybe down into the 6.3% to 6.75% range.
Okay, so maybe a slight improvement. But the key thing the sources point out is even those forecasts are still above that 6% level in the question, right?
Precisely.
Yeah.
Still above 6%, and obviously way higher than the super low rates we saw a couple of years back during the pandemic. So maybe a little relief, but hitting sub 6% this year, the analysis suggests that looks unlikely.
So what's the final probability the sources assigned to rates getting below 6% by year end?
Well, given that sticky inflation picture and the Fed's cautious stance we talked about, they're unlikely to cut rates aggressively while inflation is still a concern. The sources put the chance at around 30%.
30% again. Same number as the recession risk. Seems like a theme possible but not probable right now.
Yeah, it signals it's an uphill battle against those current economic forces, especially inflation and Fed policy. The outlook for mortgages is really tied to that bigger picture.
So for you, if you're thinking about buying or refinancing or just worried about housing costs, knowing that the sources see sub 6% rates is unlikely this year, based on this data?
Well, it helps set realistic expectations, doesn't it? Helps with budgeting, timing those big decisions.
Absolutely. Managing expectations is key. Okay, so let's quickly summarize the outlooks from the sources for these three big questions we've dug into.
Sure. So, recession risk for H2 2025. Moderate, about a 30% chance. Kind of balance between decent jobs now, but that business caution and policy uncertainty.
Nvidia stock gaining another 20%. Slightly favorable outlook, around 55% probability. Strong AI story, but big but.
Yeah.
Those export challenges and valuation questions are real headwinds.
And mortgage rates getting below 6% by year end. Looks unlikely this year. Again, around a 30% chance, mostly because inflation is proving sticky and the Fed's playing it cautious.
It really shows how tracking these specific questions, like the sources do, helps you see the evolving story, doesn't it? It's not static. New data shifts the odds.
Exactly. Understanding these shifting probabilities helps you see the bigger picture behind the day-to-day headlines and, think about how these trends might actually play out in your own life, work, investments, housing.
Totally agree. We've deep dived into recession risk, Nvidia's potential, mortgage rates, seen how the data points shape these probabilities. And the interconnectedness is just striking.
It really is. Those ripple effects are everywhere.
Which kind of brings us to a final thought for you, our listeners, building on all this. We've seen how things like tariffs can ripple through business confidence, inflation, bond yields, even mortgage rates. So the question to ponder is, what other, maybe seemingly unrelated global events or policy shifts might be quietly shaping your personal financial outlook right now in ways you haven't even considered?
Something to think about.
Definitely. Something to mull over. Thanks so much for joining us for this first deep dive on the Finance Scope.
Yeah, thanks for listening.
We hope you found this useful. If you did, please consider subscribing so you don't miss our next analysis. And let us know your thoughts in the comments below what financial questions are on your mind. We'll see you next time.